One of the most important investments the top 1% of investors use to build their fortune is through something called private equity. And today I'm going to walk you through my personal journey of investing in private equity and how you can access the asset class and make it work for you. I'm Santiago. I'm a certified financial planner, and I spend about 99% of my time researching and looking up investments. Now, if you're not familiar with the act of investing in private equity, it's the act of investing in a business that is not publicly traded on the stock market. Hence the name private equity versus public equity, what we call stocks that are invested on the stock market. You can just open up your app and invest it on Robinhood. If you think about it, if you were just to go down the street and let's say buy 10% of your local barbecue shack, then you would be a 10% investor in that business, which is a private equity ownership. Now understand that private equity has a wide range of investments. You have your local barbecue shack, but you also have multi-billion-dollar companies like Anthropic, the creators of Claude, that have not gone public on the stock market yet, and they're preparing for IPO as of this video filming. This is also a private company that you could access on private equity. So now let me start with, why did I even go down this route in the first place? And my objective was very simple to invest in private equity. Not only did I want to mimic the top investors in what they did, but I wanted to further diversify my portfolio, and I wanted what I call real diversification in the portfolio. And here's what I mean by that. When you are invested in the stock market, let's say you are invested in your 401k or a personal brokerage account, and you invest in the S&P 500. That's the most popular index. Although you may think you are diversified and it seems diversified by investing in 500 different companies, you are only diversified across a basket of different stocks. You still carry the risk of investing in the stock market as a whole. And in finance, we like to use this fancy term called beta. This is beta risk in the portfolio, right? It's just like the risk that just comes with investing in the market for being invested in the market. And sometimes the stock market just goes down because it goes down as a whole. It doesn't matter how many different stocks you own if all stocks are falling at the exact same time. Now, what the top investors realized a long time ago is that true diversification means going beyond the stock market entirely and getting exposure to asset classes that are not correlated to the stock market. So I want to invest in asset classes and businesses that have nothing to do with the stock market as a whole. And that's exactly what I wanted to accomplish by investing in private equity. I wanted to take my game to the next level like the top investors do. Now, here's where a lot of investors hit a wall with private equity. So traditionally, private equity required a lot of money up front to invest in it, because you had big private equity funds that were going out investing in multi-million-dollar companies. So for a single investment to invest in private equity, you would have to put up more than $1 million in a lot of cases. And if you're watching this video right now, chances are, just like me, you don't have $1 million just laying around to put in one single private equity fund. $1 million is a lot of money. So to get access to private equity, I use a vehicle that's called an interval fund. Now, if you're watching this, chances are you've never heard of an interval fund, so I'm going to break this down for you. An interval fund is a specially designed fund that the investment structure makes it possible to invest in things like private equity, but they make it available to retail investors like me or you by using certain regulations. These regulations are created by the regulators in Washington that set certain requirements that allow this product to be available at mass. So after I decided to go with the interval fund structure because that fit what I was trying to do, I needed to identify what specific private equity interval fund that I wanted to invest in, and I started searching. So by chance, in 2024, I read the book, The Holy Grail of Investing by Tony Robbins. This book right here by Tony Robbins. Now, I'm a big Tony Robbins fan, and it just so happens that the co-author of this book is Christopher Zook, who manages a private equity firm. And I was actually gifted a copy of Christopher Zook's quarterly reports dating back all the way when he started the firm 25 years ago. And as I studied his investment philosophy and read these quarterly reports, a lot of what he believed about markets and efficiency is what I believed as well. And in the book, when you read The Holy Grail of Investing, CAS, the fund created, was called the Strategic Opportunities Fund, which was specifically set up for retail investors like myself to get broad access to private equity investments from all the different investment managers that they interviewed in the book. So I decided to look into this fund some more and dig into it and then make my first private equity investment. But of course, all investments carry risk, and you want to make sure that it's a good fit for you before making a decision like this. Now, as I was going through this process of making my first private equity investment, before I invested a single dollar, I wanted to understand what exactly I was buying in the interval fund. So what I did was I went through the annual report to get the full breakdown of every investment inside the fund. Now, the great part of this investment is instead of investing $1 million, they made the minimum investment $2,500. So I didn't need to put up a lot of money to try this investment structure out. Like the worst case scenario, I would be out $2,500, or I could increase my position slowly over time. So it was a good risk return trade-off versus putting up $1 million and then finding out like this wasn't a good idea. I realized that for $2,500, you get a slice of a well-diversified portfolio that contained many different private equity investments within it. So you could build your own diversified portfolio at the retail level. Now, in the annual report, there was two investments that stood out to me. The first investment was the $8 million allocation that they have to the Arctos Sports Fund. But the point here is that a normal person like me would never have had direct access into an investment into a professional sports team, which is a form of private equity, unless I did it through a fund and got fractional ownership and had the interval fund access. So let's think about this from a portfolio perspective and why I wanted to make this first private equity investment. If the stock market were to drop by 20 or 30%, I now have something in my total balance sheet and portfolio that is completely uncorrelated from that move. The value of a pro sports team in this diversified portfolio is completely unaffected from the forces that change the stock market. The stock market may be moving up and down like this, but the pro sports team's value may be just slow, steady, and current because it's two separate return streams. The second investment that caught my attention was the $20 million allocation that they had to the Blue Owl GP Stakes Fund. Now, if you're not familiar with GP Stakes, I covered that in another video that I'll also link in the description as well, that this is one of the strategies that all the top 1% of investors were using to build their wealth in an exponential manner. But again, this strategy is something that otherwise would have been completely out of my reach without the retail investor interval fund. Now, before we keep going, I want to share something that I built just for you. If this is your first time being introduced to alternative investments and you want to understand what they are and why they matter to build a portfolio in this new economy, I put together a free white paper called Alternative Investments 101. You can download it directly from the link in the description that I'll leave and visit the free resources section at my website, www.financewithsantiago.com. This white paper gives you the foundation to understanding asset classes and why the top investors are using alternative investments. This is completely for free. Just visit the link below. Now let's keep going to our next section. Now, we as good portfolio managers and investors cannot talk about any private investment without mentioning the fees and understanding how this affects the long-term return. So the CAS fund has a management fee of 1.25%, but you can also account for the underlying fees of the funds that it's investing in. So let's break down how this works. CAS is gonna go to the Arctos Sports Fund, for example. Now, Arctos is still running their own separate fund, and they have their own fee structure on top of that. Usually it's a 2 and 20 fee structure. And so what you end up with is a layered fee structure. And that's the trade-off when you're accessing private markets at the retail level. Like we can't run away from this reality that you are gonna pay some higher fees than what you pay in a low-cost index fund, for example. Now, for me, personally, the trade-off is worth it, and here's why. As your balance sheet starts to grow, my overall goal is to protect downside risk and volatility. The only way to do this is to invest outside of the stock market and get decorrelated asset classes. So paying the extra fee for a strong manager with a strong track record that I believe has a sound investment philosophy that I believe in is worth the trade-off, and it's important to me. This is a big difference from the mentality that we take in the stock market, where we want to keep the fees as low as possible when you're investing in low-cost index funds, because managers on the stock market rarely even beat the S&P 500 in the index. Now, as my first private equity investment, when I was doing the research, one of the things that I learned that made me comfortable with the higher fee structure is that in private markets, there is a higher dispersion of different types of outcomes. So when we look at this chart on the screen, what this is simply telling us is that when we look at the public stocks, if I were to go out and try to get an active manager, there's little that they can do to get outsized returns. And this is because on the public stock market, access and all information is available. The same stocks that a hedge fund or some really smart guy can buy are the same stocks that you can buy on your phone on Robinhood. This is not the case when it comes to private markets. When it comes to private markets, you have to pay for access, and different managers that have specialized access and good strategies can get an outsized return. And we see this in the data here. So I was comfortable paying this higher fee structure. Now, this is not a good fit for every single investor. You need to get to the point where you're comfortable with taking on these extra fees, because diversification is more important to you than total topside return. This diversification aspect in a portfolio becomes increasingly important as you build a higher and higher net worth. This is exactly why you need to be what's considered an accredited investor to get access to things like interval funds and private equity. Now, an accredited investor is an investor that has at least $1 million portfolio, not including their personal home, or has made $200,000 for 2 years. Now, you may not be here right now, but let's think about this for a second. Let's say you're investing in your 401k consistently over years and over years and over years. You might have a $1.5 million 401k. That's not unheard of. And you're saying like, hey, I don't want all of the risk in my portfolio to just be limited to the stock market and the 401k. I want maybe some outside investments that are decorrelated from this large chunk of money in my 401k. And this is exactly what happened to me. I started off in the stock market, but as my portfolio grew, I needed other outsized returns. Now, on this fee topic, I want to throw this at you another angle too when we're thinking about private equity and why I made this first private equity investment. When you buy a home, you have your closing costs, you have your, realtor fee, the broker fee, the title fee, all these different fees that exist. But buying a home is still a legitimate investment, but you still are paying more fees than what you pay in a low-cost index fund, right? But if you really think about it for a second, owning a home is a form of a private investment. This is a private transaction that's happening outside the publicly traded stock market, and real estate is a form of an alternative investment. So these same rules apply to when we're investing in private equity. And when I looked at it through that angle, I felt very confident walking into this investment as my first private equity investment. And the other thing I will highlight from my experience is just the friction that it takes going through that subscription process. In the instance of the Strategic Opportunities Fund, you can only redeem your money quarterly, right? And so all this friction, I like it because it helps me be a more disciplined investor. A lot of times investors lose discipline in the stock market because it's so easy to trade in and out of the stock. So anytime they get uncomfortable or something bad happens in the stock market, they can just boom, snap their fingers and get their money. When we know deep down that we need to have a long-term mindset and have discipline. So although with private equity, you're gonna lose a bit of that liquidity. Liquidity is the ability to sell in and out of it. This helps you be more disciplined. When I invested in the Cash Strategic Opportunities Fund, the first 3 months or so, the price of the fund didn't even move, right? Like it was just there, and then it moved up after a quarterly reprice, and I was like, oh, cool. And then I forgot about it. Like I wasn't even thinking about it. You don't have just this day-to-day fluctuation that plays with your investor psychology. Private equity investing isn't for everyone. It does require you to have a certain level of patience. It does require you to have a certain level of risk tolerance that's different from the stock market. And it does require you to work through the friction of different minimums and subscription documents and all that process that goes along with it. But I will say that as your portfolio grows larger and larger, you do want to look at different areas to diversify your portfolio so that all of your eggs are not in one basket. Once again, you might think that you're diversified across the stock market, but you're still holding that risk in the stock market. So when you see all the stocks go down at the same time, that's a risk that you're still holding. And when you reach that point where you've built up a sizable 401k, you've built up a sizable portfolio, you start to look at different areas and different parts of the market to begin diversifying your portfolio. And that diversification piece is the idea behind the Holy Grail of investing in the Tony Robbins book. It's the idea that the top investors realize that as they are developing their portfolios, they do not want full exposure to only one set of assets, whether it's private equity, real estate, whatever it is. They want to mix and match all of their assets to build decorrelation and have this Holy Grail investment style portfolio. And that was my mindset that I wanted to take to my balance sheet. You know, Tony Robbins says that success leaves clues. So if you want to find the success like the top investors, you need to mimic what they are doing within reason and what you can do in your personal life. And now that you've seen this process and saw me walk through my first private equity investment, what I want you to do is to understand about how the top investors are allocating to alternative investments, and make sure you check out my videos that I've linked below in the description on why sports teams are a better investment than you think, and download my white paper Alternatives 101 that you can also find in the description to get your foundation of alternative investments. And then of course, make sure you subscribe to my channel, hit the like button, and leave in the comments, are you interested in adding private equity to your portfolio?